This is a global story, and as bad as things may be in the U.S. and parts of the U.K., many parts of the world are going to have it a lot tougher. How risky do you think the real shots are that there is a global food shortage, particularly in many of these developing economies?
This is really a serious problem. It has a significant amount of geopolitical risks behind it. We have to remember that countries that are in the emerging markets, particularly in the Mediterranean initially, are really dependent on Black Sea wheat and corn, but it has global repercussions. We had the Arab Spring of 2011 that came about because of the lack of Russian and Ukrainian wheat and corn. These are countries which have capital outflows, deteriorating exchange rates, and what's happening with the food and fuel problems, given where prices are on that basis, dollar denominated, there are political risks ahead for sure.
Yeah, and let's hope the best for the world. You got things like wheat, of course, Ukraine, so critical to that, cutting off the exports. Places like Egypt, they're in a tough bind. Lower prices might help. Ed, across the commodity spectrum, the things I mentioned or anything else you want to mention, do you see any price easing anytime soon for these markets?
Well, we're seeing a price divergency. So while some commodity prices going up, some are going down, some of it's temporary, some of it may be more permanent. The best news we've seen is really on the natural gas side, where natural gas prices are down about 40% from where their peaks were around the world. Not so in the U.S. so much, but the U.S. is more insulated from those global markets, but even the U.S. is down from the peaks. So we're thinking that we're going to have inventories building over the summer. It's going to make next fall and winter a lot easier where these natural gas prices are going. We have temporary downturn as we think about it in the metals complex. Virtually all industrial metals are down from their peak, whether you look at nickel, aluminum, copper, zinc, whatever you want to look at, they're down from their peaks. This is China related. It has to do with the incredible slowdown with the lockdowns. There was a little bit of optimism about the increase in the opening of the Chinese economy. There were thoughts that that might have an increase on metals prices, but just as they went down again. And we're seeing, again, a resurgence of lockdowns, even in Shanghai, where they were lifted at the beginning of the month. So it's an uncertain future, but the supplies of these metals is really more ample than people thought it was going to be. We may have, more difficult times ahead with a China and a global recovery. But for the moment, those prices are also down.
Okay, when you say difficult time ahead, do you mean maybe they lock down yet again? Or is it going to be, if they just go full bore, wide back open, what that could do to already constrained supplies, supply chains, metals, what?
So the metals have grown in inventory. There's an oversupply in the market right now. It's very unclear what's going to happen in the Chinese economy. There's the tension between opening it up, getting people employed, and keeping COVID down. And we saw that the reopening response gave rise to increased optimism about Chinese growth. And all of a sudden, we have a lockdown right again in the heart of Shanghai. We don't know
oil
what's
and
going to be
gas,
the
obviously.
future. Yes.
Yeah. Let's get out of oil and gas. Obviously, this was people care so much about because it does impact so much. You recently raised your longer-term forecast for Brent crude oil, but these levels here, 122, even the big oil bulls I talked to are thinking maybe there's room for a pullback in the near term here. What are your thoughts on oil and gas longer term?
Well, we think longer term things are going to even out. We have not only a tight market, but we have a disruption of flows, and we can't underestimate what that disruption of flows means. Europe and the U.S. have, and some other countries, but mostly the U.S. have said, we're going to get rid of our imports of Russian oil and Russian gas. On the oil side, they hope to be down to very limited amounts of imports from Russia by the end of the year, and they're also down a significant amount now. So what are they doing? They're bidding up the price of the nearest thing they can get, which happens to be Atlantic Basin crude oil, including U.S. crude oil. And we're having a two-tier pricing system globally with Russian Urals prices at a 30% persistent discount because it's dislocated from the marketplace. And Europeans are bidding up the price of what's available. We've seen a surge in U.S. exports. It's really quite remarkable. U.S. exports of combined product and crude are the highest of any country in the world, 10.5 million barrels a day in 2 out of the last 3 weeks. Went down a little bit in last week's data, but we're sure it's going to come up again because that's where the incremental supply is. It's been pulling down U.S. inventories, and that's been boosting the price on a global basis. So we think that's going to kind of balance itself out over time as the changes in the global flows get going. But we also think there's going to be a big hit to demand. I mean, we do have the summer ahead, but as you look at U.S. demand to date, gasoline demand on a 4-week moving average basis is at the lowest level in 10 years. And that's a reflection of high prices and its impact on demand. So we're seeing that. Well, we're also wondering about what the summer pull is going to be with the driving season ahead and whether the high price is going to curtail that.